Okay, we're going to do something a little bit different today. We're taking a look at the top 100 highest dividend yielding ETFs. And in the past, I'm guilty of quickly dismissing a lot of these names because I look at a single metric like the dividend yield and I assume these must be low quality funds. But I have to admit that once I gave these funds the time of day that they deserve, I looked into them, I see how they function. They're actually very unique, interesting, and different ETFs that challenge a lot of my assumptions about them. And I think that's a very healthy thing because as investors, it's very easy to develop tunnel vision and just focus on things that you like. So if you're into dividends, you focus on JEPI. Some people like broad index investing and like VTI, and others go for high growth like ARKK. But I have to say, taking the time to look into funds that I otherwise wouldn't look at is extremely refreshing and it's a good change of perspective. So this is the plan for this video. We're going to be looking at the top 5 names on this list, see their investment objectives, gain some insights on their functionality, and look at their fees, holdings, dividend data, and do some quick benchmarking. Now before we jump into this, I would appreciate a like on this video if you enjoy it, because YouTube as of lately has been not recommending my channel to as many people, and I think the algorithm takes likes into account. So if you enjoy the video, leave it a like, and that would help out the channel a lot. Okay, but let's get into this. So the first name on this list is the Columbia Research Enhanced Value ETF, ticker REVS, and it has a dividend yield of 22.99%. This is the fact sheet, and the overview is as following for this investment. So target enhanced equity index exposure through a thoughtfully designed ETF that uses proprietary quantitative research to remove the bottom performers of the Russell 1000 Value Index, delivers enhanced return potential, strives to outperform the Russell 1000 Value Index through a rules-based investment approach and research insights. And you know what? Let's go ahead right now and see if they do outperform the Russell 1000 Value Index. So VONV is the Russell 1000 Value Index. Let's come down here to the total return chart and let's add in REVS. So looking at the performance over the past 1 year, it is mostly in line with its index, but it does slightly outperform by about 3%. So that's the effect of this proprietary research process to remove the bottom performers out of the index. The expense ratio is only 0.19%, so it's not the best I've ever seen, but it's not high by any means. And if we look at the holdings, these are the top 10. So we have names like Johnson & Johnson, Citigroup, Morgan Stanley, Pfizer, even Google down here. So these are all great names, and of course they come from the Russell 1000 Value Index. But what about that dividend data? So they do have a yield of around 22%. And if we come to the history of the payouts, the first thing to note is this is a very new fund. It came into existence around September of 2019. And looking at the physical payouts, it's done on an annual basis. And the last one in 2020 was rather high, $4.66, and that's from a share price of only around $20. So that's why the yield is so high. But this does look to be a rare event, especially in comparison to 2020, the only other year of dividend payments. It looks like this is some kind of special one-time dividend event. And that's actually the case for most of the top 5 funds on this list. They have some kind of special one-time event that made the dividend yield this high. But even so, it's still a lot of fun to research and look into these rather unique and different kinds of ETFs. But I know a lot of you guys did come here for the high dividend names, so this is what I'm going to do for you guys. The 5th name, instead of looking at TAG, which is a trend aggregation growth ETF, I'm going to instead look at the name on this list that is actually a dividend ETF, and that's going to be IDIV with a real double-digit dividend yield. And yes, it does mean I'm skipping QYLD and RYLD because I've talked about these a lot on the channel, and I have to say, I think IDIV is going to be very surprising to a lot of you guys. But the next one we have on the list here is another very unique ETF. It's an AI-enhanced US large cap momentum ETF, ticker Amom. Amom is an actively managed exchange-traded fund which aims to provide investors with long-term capital appreciation by utilizing proprietary artificial intelligence systems to select large capitalization US stocks to hold in the portfolio. So it's pretty basic. It's just a US large cap momentum-focused ETF, but it has some kind of proprietary AI-enhanced mechanism to select for these funds. Here's a bit more information on that. So the fund utilizes artificial intelligence to determine how a company's momentum over a certain period would change and or affect the company's performance over time, and it recommends a weighting of such company based on its potential for maximum returns as compared to other companies. So that's the details. And they're going to charge you an expense ratio of 0.75% for this AI enhanced process. And these are the top 10 companies that AI has picked, and they are large cap momentum companies. So we have Amazon, Home Depot, Lowe's, Target, Colgate even. And in terms of a benchmark, this is the total return over the past 1 year. And let's add in SCHG. This is a generic large cap growth ETF. So I feel like it's a fitting comparison. And they are in fact very similar to one another. If we zoom out to 3 years, unfortunately this ETF isn't quite 3 years old, but still we can see it's mostly in line with a generic large cap growth fund. So that leads me to believe that the high expense ratio that you're paying for this AI enhanced performance isn't really worth it because it's not outperforming its benchmark. This does have a very high 22.5% dividend yield, but if we come to the dividend history, it seems to be much the same story as before of having a one-time very large payout. The next one is a sustainable future ETF. So as I mentioned in the beginning of this video, this is a very diverse group of funds, and I have to say it's very refreshing to research all these different kinds of ETFs. So this fund is based off of the MSCI Global Environmental Selection Index. The index is comprised of companies that focus on offering products or services that contribute to a more environmentally sustainable economy by making a more efficient use of global resources. The index is designed to maximize exposure to 6 environmental impact themes: alternative energy, energy efficiency, green buildings, sustainable water, pollution prevention and control, and sustainable agriculture. The fund has a management fee of 0.5%. The top 10 holdings, we have names like Tesla, NIO, which are all electric car makers, Digital Realty Trust, I'm a little surprised to see that one, and names like Enphase Energy. Looking at the performance over the past 1 year, it does lag behind the market a little bit, but if we zoom out, this ETF had a phenomenal 2020, and because of that, it actually does outperform the market. But the reason why you would invest in a fund like this is because you believe in a sustainable future and you want to invest in that technology. In terms of the dividend data, again, it looks like this is a special one-time dividend payment. All right, moving on to the next one on this list. This is from VanEck, and it's a China Growth Leaders ETF, ticker GLCN. And this is going to be a very sad story because right now, Asian and more specifically Chinese stocks are performing very poorly due to various news. So the VanEck China Growth Leaders ETF seeks to replicate as closely as possible before fees and expenses the price and yield performance of the market greater China All-Cap Growth Leaders Index, which consists of fundamentally sound Chinese companies that exhibit attractive growth potential at a reasonable price. And right here, they show us the top 10 holdings. We have very familiar names like JD. This is a company that ARK Invest is very bullish on. We have Tencent Holdings, Alibaba. There's a total of 201 holdings in this fund, and the management fee is 0.5%. Now, I thought CQQQ is probably the best fund to benchmark this one against because this is a China technology ETF. So if we come over here and put in GLCN to benchmark it against, they're pretty similar to one another. In fact, in terms of price movements, they're almost a mirror image of one another, but it does seem to underperform CQQQ, which of course focuses more on technology rather general growth. And if we zoom all the way out to 5 years, CQQQ does seem to be the better alternative if you want exposure to Chinese growth. Although I don't know if you actually want that because if you compare this versus the US market, the US market has definitely been doing a lot better. And if we zoom into just the past 12 months, the US market has returned 30% and even CQQQ has been negative 8.35%. Their dividend is 15.39%, but something tells me that's a special one-time payment, and that seems to be the case here again. Although it does look like back in 2019 they also had another special payment, not quite as high, but maybe this is something the fund does. Okay, so now as promised, as the 5th and final ETF, instead of looking at TAG, which is a trend aggregation growth ETF, which does sound very fascinating in and of itself, let's find an ETF that actually focuses on providing a high dividend. And the first name on this list that follows that is actually QYLD. But I've talked about this ETF a lot on the channel, it's very popular, so let's skip that along with RYLD. And that leaves us with this one right here, ticker IDIV, and this is a US Equity Cumulative Dividends Fund Series 2027. And here's the fund overview. So IDIV seeks to provide returns generated by the dividend growth of the S&P 500 while making monthly payments to replicate the actual dividends paid by the constituent companies. Essentially, IDIV offers exposure to the dividend-only component of the index and therefore has no stock price exposure. So that's pretty interesting. And to put it simply, the fund objective is to simply replicate the actual dividends paid by the S&P 500 without stock price exposure. And they do list some benefits right here of the strategy. So this one is inflation hedge strategy. And it says dividend growth has been the most correlated asset to inflation, especially during times of high inflation, which might be kind of relevant right now. Low volatility strategy. So dividend growth has been positive in 54 out of the last 60 years, as business leaders are reluctant to cut dividends. They also mention that dividends are not affected by stock valuation, so high PE multiples. And lastly, dividend growth is fully managed by business leaders, unlike stock price returns. And I have to say, all these things are true, and it's why I like investing for dividends. So dividends are super stable, they're set by management, so it's not fully reliant on how other people value the company, like the stock prices, and they're pretty independent of high valuations. The expense ratio is a little bit high at 0.87%. And if you look at their top 10 holdings, the way they accomplish this is not by investing in the S&P 500, but rather all of these derivatives and options. So the first largest holding is the United States Treasury notes. So I'm assuming this is to add a lot of stability to the fund. And then it's followed by put options on the S&P 500 that expire in December. So definitely a pretty unique strategy here in order to isolate the dividends from the S&P 500. And speaking of dividends, let's take a look at the history. So right now it does have roughly a 13% dividend yield. And if you look at the history of these dividend payments, it is rather consistent. Unfortunately, there's not a huge history behind this ETF, but there does seem to be some kind of growth in this dividend like advertised. And lastly, if we compare IDIV's total return to the S&P 500, they're actually like really close. Zooming out a little bit to 3 years, IDIV does fall behind the market, which is to be expected. The goal of this ETF does seem to be to provide consistent, very high dividend payments while not exposing you to all that volatility of the price movements of the S&P 500. So that's the video. Hopefully we all learned something new. As mentioned, I think it was really refreshing to take a look at some of these ETFs that we might not otherwise have looked at. We had strategies ranging from sustainable future to AI enhanced large cap momentum to proprietary research enhanced value ETFs on the Russell 1000 index. Very interesting. Most of them, in order to get on this list, had a special one-time dividend, but down here, ticker IDIV, is an actual dividend-focused ETF with a very high double-digit dividend yield that has a very unique strategy as well, trying to capture all the dividends of the S&P 500 while isolating you from the price movements and the volatility of the share price. That's going to do it. If you guys are still watching and enjoyed, give the video a like. It helps out the channel a lot. Subscribe, do all that YouTube stuff, and I'll see you in the next one.